Reinvesting profits. One of the most powerful ways that the wealthy use to escape high tax rates is through the reinvestment of profits. Instead of distributing earnings in the form of dividends, which are heavily taxed, profits are put back into the business itself. This creates a cycle of exponential growth. The money that would have been drained by the tax authorities is instead allocated to expanding operations, hiring more employees, developing new products, or improving infrastructure. And the most interesting detail is that the government doesn't tax these reinvested profits. This mechanism allows the company to grow rapidly, while the entrepreneur's net worth also multiplies. Large corporations and smart entrepreneurs use this strategy to turn net profits into assets, thus avoiding a sizable income tax bite. What might seem like a simple business strategy actually represents one of the elite's most effective secrets for keeping their wealth constantly growing. What's more, by reinvesting, the entrepreneur has complete control over how this capital will be used, which further increases the chances of long-term success. The company can open new units, explore international markets, or even invest in technological innovation, which puts it ahead of its competitors. Meanwhile, that amount that would have gone to the government is now creating more wealth within the organization itself. The crucial point of this strategy is that, by reinvesting, you not only keep the money out of the reach of immediate taxes, but you are also building a stronger foundation for it to grow even more in the future. In this way, the rich are able to escape heavy taxation while continuing to grow their assets and consolidate their financial empire. Deducting business expenses. Another essential strategy that the rich use to escape high taxes is the business expense deduction. This tactic allows them to buy items and pay for services that would be personal expenses, but which, when purchased through their companies, can be deducted from taxable profits. This means that expenses such as technology, luxury cars, travel, and even some forms of entertainment can be accounted for as a business cost, which significantly reduces the amount the company reports as profit, and consequently the amount of tax to be paid. Imagine an entrepreneur who needs a car to travel to business meetings. Instead of buying the vehicle himself, he does it through the company. The car, which in other circumstances would be a personal purchase, now becomes a work tool, and its costs from acquisition to maintenance and fuel can be deducted as a business expense. This directly reduces the company's taxable profit. The same applies to devices such as smartphones, laptops, and other technological items, which are essential to the operation of many businesses today. With each new purchase, another slice of profit is exempt from tax. In addition, corporate travel is another area where the wealthy get big advantages. Meetings with clients, international conferences, and visits to other headquarters or suppliers are classified as business expenses. This means that first-class tickets, stays in luxury hotels, and expensive meals, when justified as part of the job, are covered by the company and can be deducted from taxes. This practice is not illegal, but it shows how the tax system favors those who have the knowledge and resources to use it to their advantage. Well-structured companies allow the wealthy to maintain their comfortable lifestyles while paying less tax than most people realize. Using assets as collateral for loans. The rich have mastered a sophisticated technique for evading high taxes, using their assets as collateral to obtain loans. Instead of selling stocks, real estate, or other valuable assets and paying a significant slice of those gains in taxes, they prefer to keep those assets intact and instead use them as collateral to get loans. The beauty of this strategy is that when you take out a loan, you don't pay taxes on the amount you get, as the loan is not considered income. When an ordinary person needs money, their first reaction might be to sell an asset, such as property or shares. But for the rich, this would be a strategic mistake. When they sell an asset, they have to pay capital gains tax, which can be substantial. Instead, they choose to take out low-interest loans, often using their shares, real estate, or other high-value assets as collateral. This gives them access to the capital they need, but without triggering a taxable event. For example, a billionaire who owns a vast amount of shares in a company can apply for a multi-million-dollar loan from a bank using those shares as collateral. As long as he keeps the shares, any appreciation they experience continues to benefit his estate. And, unlike most people, he doesn't pay taxes on the amount of the loan received, because it's not considered a gain, but a debt. Another benefit of this tactic is that, in many cases, the interest paid on these loans can be deducted from taxes, creating a double advantage. Not only do they not pay tax on the amount borrowed, but they can also reduce their tax burden with the interest deductions. It's a move that shows how the financial system can be manipulated by those who have access to the capital and knowledge necessary to play the rules in their favor. Donations to charity. One of the most elegant and socially acceptable strategies that the rich use to reduce their tax burden is through charitable donations. Although at first glance it seems like a purely altruistic act, the reality is that these donations are often made strategically in order to avoid significant taxes. The wealthy often set up their own charitable foundations, which allows them to control how the money is used, while taking advantage of tax deductions. When a billionaire makes a large donation to a charity, they can deduct that amount from their taxable income. This means that the government considers this donation to be a reduction in his earnings, lowering the amount of tax he has to pay. But what makes this tactic really powerful is that these charitable foundations are often run by the donors themselves or their families. Instead of simply donating large sums to unknown institutions, the wealthy create their own foundations, allowing the money to remain under their direct control. This allows them to ensure that the funds are used according to their preferences and interests, while enjoying the tax benefits. And there's more, donations don't have to be used all at once. Foundations can invest the donated funds, allowing the capital to grow over time, and only a portion of this amount is distributed to social causes on an ongoing basis. The money continues to work for them, even within the foundation. In addition, this strategy also improves the public image of the wealthy, who are seen as philanthropists, even though they are using charity as a way to avoid paying high taxes. Although this is not illegal, it is a clever way of redirecting taxes that would otherwise go to the government to causes that they consider more beneficial and under their supervision. Payment in shares, not salary. One of the smartest strategies the rich use to avoid high taxes is to receive compensation in the form of shares, rather than a cash salary. By opting for shares, they are able to postpone their tax liability until the moment they decide to sell these assets, often years later, when they can better plan how to minimize the impact of taxes. When a person receives a traditional salary, this amount is immediately subject to income tax, which can result in a large chunk going straight to the government. However, when the wealthy receive part of their remuneration in company shares, they don't have to pay tax until those shares are sold. This creates a double advantage. They postpone paying taxes, and during this time, the shares can appreciate in value, further increasing their wealth. For example, many executives of large corporations receive compensation packages that include shares in the company. They can choose not to sell these shares for years, allowing the value to continue to grow. During this period, they can live off other sources of income, such as dividends or even loans secured by these same assets, without ever having to pay taxes on the full value of the shares. What's more, when they finally sell these shares, they can do so at a more strategic time, taking advantage of lower tax rates, such as long-term capital gains, which is generally lower than the rate on income. This is an important differentiator, as it allows them to pay less tax than they would if they received the same amount of money in the form of a regular salary. The use of share-based payments is one of the reasons why major CEOs and executives are able to maintain a top-level lifestyle while paying proportionally less tax than workers who receive a traditional salary. It's a masterstroke, taking advantage of legal loopholes in the tax system to maximize wealth. Transferring profits to other countries. One of the most widely used strategies by large corporations and wealthy entrepreneurs to avoid high tax rates is to transfer profits to low-tax countries, such as Ireland. This practice, known as tax optimization, allows companies to move their profits to jurisdictions where the tax burden is much lower, saving billions in taxes. Large multinationals such as technology companies, for example, take advantage of this strategy by establishing headquarters in countries where tax rates on corporate profits are extremely low. Ireland is one of the most popular destinations for this, with a corporate tax rate of just 12.5%, well below the rates in the United States or many European countries. So instead of reporting all their profits in the countries where they do most of their business, these companies are legally able to move a significant part of those earnings to these tax havens. The mechanism works simply. The company creates a subsidiary in a low-tax country. Then, through a series of transactions and accounting adjustments, a large part of the profits generated in other markets is attributed to this subsidiary, even though the actual work was done elsewhere. This results in the profits being taxed based on the laws of the country where the subsidiary is located, resulting in huge savings. This practice is also facilitated by loopholes in international tax laws, which allow the transfer of intellectual property rights or royalties between different countries. This allows companies to shift earnings associated with patents, brands, or technologies to countries where taxes are lower. Although many governments have tried to close these loopholes, the richest multinationals continue to use these tactics to minimize their global tax burden. With the globalized economy and complex legal systems, shifting profits to low-tax countries has become one of the most effective tools in the arsenal of the rich to maintain their wealth. Buying art as a tax deduction strategy. Buying art is a clever strategy used by the rich not only to collect valuable works, but also to reduce their taxable income. This tactic allows them to evade a considerable amount of tax, while at the same time increasing their wealth with high-value assets. Art, as well as being a status symbol and a form of investment, becomes a powerful tax planning tool when used strategically. When a billionaire acquires a work of art, it is often kept as an asset that appreciates in value over time. The real magic happens when that work is donated to a museum or foundation. By making the donation, the owner can deduct the market value of the work from their income tax, which can be substantially higher than the price originally paid. This difference is what generates a major tax advantage. The appreciation in value of the work allows for a much larger deduction than the amount invested, resulting in significant tax savings. What's more, instead of selling the work and paying capital gains tax, the wealthy prefer to donate it, which ensures that they don't have to pay tax on the appreciation of the asset. What's more, many of the wealthy donors retain control over the piece's fate, as they are often associates or even owners of the foundations or museums that receive these donations. In this way, they are able to preserve the status and cultural ownership of the piece, while benefiting financially. Another aspect of this strategy is that, by reinvesting the value of the sale of works of art and other acquisitions within a short period, they can use tax loopholes that allow them to postpone or avoid taxes on the profit made. In this way, art becomes not only an investment asset, but also a vehicle for preserving wealth and reducing the tax burden. Creating trusts to avoid inheritance taxes. One of the most effective ways that the wealthy use to protect their fortunes from inheritance tax is through the creation of trusts. This legal instrument allows them to transfer their wealth to heirs without the value being totally diluted by the heavy inheritance taxes, which in many countries can grab a considerable part of the estate. A trust is essentially an agreement establishing that a certain amount of money or assets will be managed by a trustee for the benefit of other people, such as children or grandchildren. By creating a trust, wealthy people are able to protect their assets from paying excessive taxes, as these assets are transferred to the trust while they are still alive, avoiding the taxation that would occur if they were passed on directly as inheritance after death. A well-structured trust can even ensure that assets are preserved over several generations, shielding them from laws aimed at redistributing wealth through taxes. In addition, the creators of trusts often set strict rules on how and when beneficiaries can access these funds. This means that although the money or assets technically belong to your heirs, they cannot be spent freely. Beneficiaries usually receive stipulated amounts over time or under certain conditions, such as reaching a certain age or meeting certain criteria, like academic qualifications. This not only protects the fortune from mismanagement, but also allows the founders to maintain a certain level of control over the use of the money, even after their death. Another benefit of using trusts is that they can be set up in specific jurisdictions that offer more tax advantages. There are places where taxes on these instruments are significantly lower or non-existent, which makes this strategy even more attractive to the wealthy looking to maximize the preservation of their fortunes. In the end, the creation of trusts is a shrewd move to ensure that the rich not only keep their wealth, but also prevent a large part of it from going to the government, preserving their inheritance for generations to come. Asset depreciation as a tax strategy. Asset depreciation is one of the most powerful tax strategies used by the wealthy to reduce their taxable income and save on taxes. The concept is simple but incredibly effective. When they acquire assets such as real estate, vehicles, or equipment for their business, they can depreciate the value of these assets over time. This depreciation is deducted from their taxable income, which in practice reduces the tax burden they face each year. When a wealthy businessman buys a property or a fleet of vehicles for his company, the total value of these assets is not deducted from his taxes all at once. Instead, the government allows the value of the asset to be spread out over several years, based on the asset's estimated useful life. This depreciation process allows the entrepreneur to record an annual expense, even if the asset is in use or even generating a profit. The result is an artificial reduction in the company's accounting profit, which leads to lower tax collection. For example, if a millionaire buys a commercial property for 10 million reais, he can depreciate this asset over decades, deducting part of the value each year. Even if the property appreciates over time, he continues to enjoy the tax benefits of depreciation. The same goes for vehicles or technological equipment. Although these assets are still in use and may be adding value to the company, the annual tax deduction allows the entrepreneur to pay less tax than someone who doesn't use this strategy. This practice is a legal and common way of maximizing net profit. While most people see depreciation as a loss of value, the wealthy see it as a tool to escape heavy taxation. And when combined with other tactics, such as reinvesting profits, it becomes part of a tax arsenal that allows them to accumulate more and more wealth while paying proportionally less tax. Moving to tax-free countries. One of the most radical and effective strategies that the rich use to escape high taxes is simply to move to countries that don't levy taxes on income. Places like Dubai in the United Arab Emirates and Monaco in Europe are popular destinations for millionaires and billionaires looking to maximize the retention of their earnings without the interference of heavy tax obligations. The attraction of these countries is clear: the absence of income tax. In Dubai, for example, individuals and companies can earn fortunes without having to pass on a significant portion to the government. The same is true in Monaco, known for its opulence and for being home to some of the world's wealthiest individuals. This lack of direct income tax allows the wealthy to preserve much more of their earnings while enjoying a luxurious lifestyle in modern, safe cities with a high quality of life. The move to these countries is not just about enjoying exotic beaches or first-class infrastructure. For many, it's a long-term strategic move. By becoming tax residents of countries like Dubai or Monaco, they are able to keep their business or personal earnings virtually untouched by the tax authorities. This type of move is common among tech moguls, sportsmen, artists, and other high-income earners who are looking for a way to legally avoid paying heavy taxes. As well as avoiding income tax, many of these countries also offer other tax benefits, such as no tax on capital gains, inheritance, or dividends, making them even more attractive to those with considerable assets. It's no wonder that large fortunes continue to migrate to these regions, where the high cost of living is more than offset by the huge savings in taxes. For the rich, this move could mean the difference between losing millions to the tax authorities and ensuring that a large part of their wealth remains in their hands. The combination of tax advantages, luxury, and security makes places like Dubai and Monaco the true tax havens of the modern world, where financial freedom is maximized. Thanks for watching. If you like the content, don't forget to leave your like. It really helps the channel to grow. And if you're not subscribed yet, take the opportunity to subscribe now and activate the notification bell so you don't miss any of the upcoming videos. And of course, let me know in the comments what you think or if there are any topics you'd like to see here. I read everything and always bring you what you ask for. Thank you very much for your company, and I'll see you in the next video.